Welcome everybody to Value Investing Live. I'm pleased to welcome our guest this week, Keith Smith, the portfolio manager of the Bonhoeffer Funds. He last joined us in July of 2021. If you missed that presentation, there's a copy of it here on YouTube as well as on GuruFocus. As always, please post your questions in the live chat throughout the presentation. And also let us know where you're viewing from, because we do love to see those international audience members out there. Without any further ado, I will hand things over to Keith.
Well, thanks for having me back again. This has been the last time I really enjoyed it, and hopefully y'all get a good sort of view of sort of the way we look at specific companies. And we're going to do this in a similar format we did last time. We're going to talk a little bit about more theoretical concepts and more of approaches, and then go through two specific examples in regards to that. So if we start out, the overall topic is operational leverage, franchises, and markets in transition. And so overall, first I've got sort of the disclaimer statement that this is for entertainment purposes only. Do your own due diligence on any of the ideas that we describe here. And this is not a securities offering. So we'll start out. What a lot of folks are looking for in this market and firms in general are what's described as sort of franchise firms. These are firms that have high returns on capital. And some of the characteristics of those firms include things like exclusive or oligopolistic franchises, car dealers, telecom cable. So you have reduced competition. Another characteristics of some of the franchise firms is cost advantages through economies of scale or scope. They also can have revenue advantages, either networked economics or customer lock-in. Some examples of those would be like software, where once you install a piece of software, you build processes around it and it becomes somewhat locked into. And there's other particular products and services where that lock-in can occur. And then the final thing is slowly changing market share. What that really allows you to do is to see this over time. If you have some of these other advantages, but then if the market share changes relatively quickly, then it can negate a lot of them, and basically it becomes a much more difficult way in the fact that you have to spend a lot of money on customer acquisitions continuously, and that just hits the bottom line overall. So what the focus of this particular presentation is going to be on, one aspect of it is what I describe as markets in transitions. These are markets where they're being fragmented by, in this case, technology or new versions of what the current companies are providing. And what it can provide is both organic growth opportunities in the new space and consolidation growth opportunities in the fact that once a market becomes more fragmented, you can consolidate and get the advantage of consolidation. So for example, innovation can create new or modified value chains. In the two examples that we're going to talk about here, one is Scripps Networks, which basically EW Scripps. So they're a legacy TV provider, and they're also developing a network, a television network. Historically, there's that ecosystem, but what's really changed now is you have streaming and connected TV. And so that's the disruption. And so there's a little bit of a different ecosystem in terms of what they've built around for two of those. And we'll take a look at what Scripps has done with that. Consolidated Communications is the other example. And in those cases, what you'll really see is it's transitioning from a copper-based system to a fiber-based system in regards to providing telecommunications and broadband communications. And so that's another example of how the value chain is being modified, not necessarily totally changed. In places where it's totally changed, then actually competitors can have a huge advantage, where a lot of the value chain is just modified, the incumbents can have more of an advantage. So in this case, what's happening in both of these companies is the incumbents are adopting the innovation and value chains will be modified. Like saying where the value chain cannot be modified, that's where there's a lot of turnover, and it becomes an example of that could be in some high-tech companies, like for example in disk drive sizes. If you look at memory storage for disk drives over time, it started out with a large floppy disk, went to a smaller floppy disk, and then went to hard disk, and then now. So in each generation, there was a different ecosystem that was built around the companies to build that. However, what happened was they were so different that very few companies were able to migrate from one generation to another. In the two cases we're talking about here, there is a good amount of migration in terms of they can take a good portion of what they already have and just reuse it in a different context. They just need to make sure that they're actually adopting the innovation as opposed to trying to work against it. And so in the examples we've got of legacy mature business generating cash flow, and there's a fast growing business underneath it. So in Consolidated Communications, the fast growing business is fiber optic broadband connectivity. The legacy business is telephone and copper based broadband. And so you have one replacing the other. In Scripps, it's legacy local TV networks. The future being connected TV and various what's called ATSC 3.0, which are basically ways that they can use their spectrum to provide broadband connectivity to a number of different users. So that's general sort of the markets in transition. The next piece that can add some interesting to this is sort of fragmented markets. Fragmented markets provide opportunities for growth that don't necessarily require the market itself to grow. You get growth primarily from consolidation within the markets. And there can be long runways associated with these. And as what you'll see, like, for example, in the local TV market, is the local TV market, when they merge the various TV stations, you get a lot of local synergies. For example, you can save you can do common production, you can do, there's a lot of synergies within local TV markets to sort of roll these things up. And then basically what that allows them to do is to generate cash flow growth from the synergies in addition to the organic growth. Now, the local TV market, the organic growth is flat, but what's actually going to be happening is with these economies of scope and scale, you can actually get a growing one. But then there's also other opportunities. For example, the CTV market and the local TV market, where companies can take advantage of that as they transition to ATSC 3.0. So that's an example of specifically a runway that we're going to look at here. The innovation, as we had mentioned before, can add additional fragmentation to the market. You're breaking up demand between online, offline, and omni-channel. And so what's happened is you have these new online only competitors coming in. But I think in the end, what's going to happen is going to be sort of a combination of both, and people will be able to pick and choose which one they want. The nice thing about these types of markets is there are a number of markets, and they can have a tendency to happen in countries and around the world. So there's a large number of companies you can look at, and then basically be able to choose between those in terms of across markets and various geographies. So, for example, these are some examples of sort of fragmented markets that we've looked at in the past, and I think that provide good examples of these types of markets. The first one is sort of equipment leasing. So these both Ashtead and URI do equipment leasing in the United States. It's a very unique market versus other markets because of the potential of consolidation. They're the two largest players. They by far have a financing advantage over competitors. And they also basically can develop these clusters and build out those clusters and create an advantage from that perspective. Then another one is automobile distribution. And so these are like car dealerships. Examples of that could be Cambria and Motorpoint in the UK, of sort of a fragmented market. A lot of those ones, they have very low market share, but over time, they should be able to roll those up. The same thing with Ashtead in terms of the percentage market share. In the United States, home decor value retailing at home in the United States is an example of that. An example in the US in terms of connectivity is Consolidated and Frontier Communications. And so those guys are examples of sort of where there is a fragmented market that now is the fiber is basically replacing the copper or the older sort of broadband and other types of connectivity technology. So what we're focusing on in this sort of view here is examining incumbents that are adopting the innovation that can enhance growth, necessarily may not be reflected in the price, because what can happen here is the market focuses on the legacy business and prices as though it's a legacy business, but there's actually an underlying growth business. Once the underlying growth business reaches a certain stage, then there's somewhat of a transition. So the advantage of some of these types of companies is it can create some really interesting opportunities in regards to that. So if you've got this situation where you've got an old co and call it a new co, so a new co would be the growing. So for example, let's take a look at Consolidated. The new co would be the fiber optic company that they have. The old co would be the traditional copper telephone company. So there's a number of options that corporate managements have when they have this kind of situation. One is pretty obvious, is you can spin the new co. Now, depending on whether you can either spin it or hold on to it. The advantage, when you would want to do a spin, if there's little or no synergies or shared customers, and the company can be financed from other sources. And then, of course, if there's a large difference between old co and new co. Now, you may want to keep them together if there's sales and marketing overlap in terms of their customers. So, for example, Consolidated Communications, there's overlap between the old customers and the new customers. So it makes sense for them to keep it together as opposed to being it spun out. And the same thing for Scripps, for all of their advertising customers. It makes sense for them to hold on to it because you can basically leverage the older customers, basically to continue to grow your segment, your sales from that perspective. And then the other aspect of it in both of these cases is that you can use the cash flow from the old co, because typically an old co is a company that has a lot of cash that doesn't have many reinvestment opportunities. The new co provides reinvestment opportunities at relatively high rates of return. So it's really sort of a nice sort of combination. So as we talked about before, some examples here is fiber connectivity and Consolidated, where fiber is replacing copper. Content distribution, which basically is Scripps. It's over the air versus connected TV and the other sort of ancillary things that ATSC 3.0 can provide for some of these operators. And then in auto distribution, it's the auto distribution, you have the online players. You'll have the traditional guys like Asbury, and then you'll have the online players like Carvana and sort of and the Vroom and these other types of players. And so the real question is, okay, does it make sense to keep them together or break them apart? I think in the two situations we're looking at here, it makes sense to keep them together. And therefore that's it. But that just provides a little bit of framework of when you're dealing with this old co, new co situation, what are some of the options that management has there? So where the opportunity lies in these types of businesses is many firms can be priced as legacy declining firms. And one way to sort of measure that is there's a Graham formula, which is 8.5 plus 2G, which basically says that, okay, a zero growth company should have roughly a multiple of 8.5. Now, where that formula comes from, it's a simplification of a more complex growth stock formula. So if we use that as a benchmark, what that's really saying is a 12.5% free cash flow yield implies no growth for the business over the longer term. Now, if you look at some of the companies, for example, Scripps right now is selling at about 5 times free cash flow, at 20% free cash flow yield. So the implied growth rate in Scripps is actually negative. And so what that would really imply is that if the company keeps its revenues and cash flows the same, or even if it has a possibility to grow it, it provides a really sort of interesting leverage aspect of it, in the fact that you can not only will the cash flows grow, but the multiples that's applied to that cash flow will grow because the multiple is so low today. We'll take a look at the same thing in Consolidated Communications. That one's not quite as clean as Scripps is, because what you really need to do in the telco companies is you need to go out and model the specific new fiber overlay in the old declining business. And so it's a little bit more complicated, but the concept is pretty much the same. So what this provides is what some people have described as the Davis double, and which basically means you get earnings and multiple growth opportunities, which I think are what investors really try to look for today. So what you have in these situations is the underlying cash flows improve as the transition progresses, and the multiple will increase as NewCo, which is the growing company, becomes a larger part of the firm overall. So you really get sort of this multiplication effect. And these are the types of opportunities I think a lot of investors look for, and two that we'll examine here today. There are some risks. These may actually be other ways. There actually may be sort of opportunities for people to buy these at even cheaper multiples when these things happen. The key thing behind this really working is the timing. So what happens is if there's any sort of mismatch in timing. So for example, let's say right now we've got Consolidated Communication rolling out their fiber, and the copper's right there. If the fiber rollout gets delayed, for example, then what that's going to do is it's going to push out the growing cash flow further out. The declining cash flow is going to decline some more. So in essence, you're going to get like a hole or a bump in the road. And that may be a point where, again, if it's the market's valuing this as a legacy business, they get more reinforcement. Okay, the legacy business is here, is what's going to be dominant. And so that's a real opportunity. So one of the key things here is just that transition and tracking that transition over time, which we can do for each of the companies by just seeing how is a new business project going up versus the old business declining. And then another aspect of this is risks. Is if there's a good amount of debt, that magnifies the upsides and the downsides. So if you find a good opportunity here and they can be levered by a cheap amount of debt, you'll get some good upside. But if there's any bumps in the road, it's going to get volatile, and you may get some more downside from that also. So that's in general just about sort of markets in transition. Now, what I'm going to describe next is another way where you can actually get growth in companies that's independent of organic growth. Organic growth is nice, but you can actually get growth in companies from consolidation. This is where companies are sort of merging together. And there's been a number of different models that people have put together, or frameworks, I think, that are useful to think about these consolidated companies in. They categorize them either by categories by levels of integration, which basically Scott Management, and we'll go through the chart here, and a Canuck analyst basically have come up with two, I think, really good frameworks and descriptions of the different types of consolidation that can happen in the markets and the various characteristics of those. And then also importantly, I think Canuck analysis put together a pretty good sort of framework to basically benchmark these companies to say, okay, how do we actually sort of figure out which companies are better or not? And they basically have focused on sort of return on capital plus organic growth. I think they use Mark Leonard, who's another guy who is very good in this sort of consolidation game. Basically uses organic growth plus, return on capital plus organic growth. But that's a benchmark that you can sort of measure of how well these companies are really doing. So if we go to the first one here in terms of categorizations, so the various way you sort of categorize sort of these consolidations, it goes from the real simple over to the left, where you're basically buying the same businesses, rolling them up over time. So examples would be Waste Management, that's rolled up the waste collection space, very global, that's done the same thing in plastics, and Johnson Services. The next one is basically platforms. Now, platforms are ones where you have different products. There's product differentiation, but you cluster these products. So you set up an initial platform of one type of a business, and then you consolidate that business. And then a second type of a business, and you consolidate that. And then the third one is sort of accumulator, where it's basically shared operations. And this is an example, Constellation Software, where Mark Leonard's the CEO. Basically, this is an example of this, where from vertical market software, each one of the segments is different because it services each different company. And so each of them is different, but they have a commonality. And in those types of situations, you can build some advantage. And what Mark Leonard has done, which is really incredible in terms of Constellation, is built an M&A machine to really develop and push down the merger and acquisition down to the lower levels so he can continue to maintain the growth of the business. And then all the way to the right are sort of holdcos. These are sort of unrelated businesses. Now, these historically have had large discounts due to just the fact that there's sort of unrelated businesses and there's some business expenses. I think that's just a nature of those types of companies. And so the ones we're going to be talking about today are probably more roll-ups, but then there's also the platform and accumulator, which are very interesting types of business models. But I think those are things that we've looked at. But at this point, we think a good amount of opportunity can be found in the roll-up category of these. But other people, I say, focus on the platform and accumulator aspects of this type of business. Now, this is a second sort of model that gets into a little bit more detail that a Canuck analyst basically put together. And I really like what they do here, because they break out, they say TAM, which is total addressable market. So basically, for a roll up, your market's very narrow. So you're constrained in terms of the specific targets you're going after. Platform's not as much an accumulator, it's just you have a very wide amount. But the real question is, okay, then the resource and process constraint. How much time do you have to actually spend in trying to put together an M&A program? On a roll up, they do have some people doing that, but a lot of it's just sort of operational. You can sort of see what's going on. When you're getting a platform and accumulator, you're dealing with multiple businesses. So you have to build up a team that really understands each one of these businesses and can do, the relevant amount of due diligence to make sure that the characteristics you're looking for are in those businesses. And so as we talked about sort of the TAM there, the opportunities, I think the key thing to look at each one of these is sort of the risks. And so the key thing is for roll-ups is multiple escalation. As there's multiple people doing roll-ups, the multiples can go up. And the other sort of, not necessarily red flags, but things you need to look at is international expansion. Does international expansion make sense, especially if you're dealing in a local market? Will that really add value, or will that detract from value? And or will it, what's called the diversification? In other words, you've just gone overseas, but you really don't have any scale over there, and it's really been more of a distraction than actually a value add. And then as you're going from the left to the right, what's going to happen is you have to spend more time on trying to understand deals and basically be able to do deals across different types of verticals. But in all cases, what these guys are doing is they all know other industry players, and so this is just a further use of the knowledge they have in the industry to basically expand their markets. Now, in the roll up, it's very easy because you're focusing. It becomes more challenging when you're doing platform and accumulator because you're dealing, again, across other types of industries. And you're really looking at more things like culture and the more soft sort of things, and making sure the incentives are set up right there and that you have a common culture and way of looking at things for those types of businesses. And one of the key things they talk about here to monitor in the roll up, I think most of the opportunity is where the top consolidators have very little bit on the market share. When the top consolidators have large amounts of market share, by large amounts, I say the top 2 or 3 guys have 50, 60, 70% of the market. At that point, you're not going to be able to accumulate very much anymore. And therefore the opportunities of growth from that avenue are decline quite a bit than if you have like if the biggest guys have 1 or 2% market share. So that's a key thing in terms of the roll up. In terms of the platforms, what you really need to look in the platform and accumulators is you really need to take a look at the historical record, because and whether they've really been able to follow through on what they've done. Have they been able to incorporate the cultural aspects of the businesses they're looking for and develop this culture of continued growth and continued sort of work through these particular situations. And so this is again sort of a nice way of looking at at different types, the different companies, and then based upon their size, how much return on invested capital, and is it half organic or whatever the organic growth is. And what this generally shows, as the companies get larger, as you'd expect, the growth opportunity plus the return on invested capital basically goes down. And so if you take a look at some of these smaller ones, that's where I think a lot of the really interesting opportunities are. If you can find one that you believe in that can roll up stuff by a whole lot, it becomes very, very interesting. Again, the offset of these is a lot of times these smaller companies are selling for very high multiples, and so you have to be pretty sure that they're going to be able to deliver. But the other opportunity is, given the high multiples and given what sort of happened recently, is a lot of these have come down quite a bit. And so and it will be volatile. So if you can find a time when, okay, the long-term plan seems to be going fine, but they're just hitting a short-term or mid-term sort of stumbling block, that's where I think there's some opportunities amongst these types of businesses. And so I think that's it. And I'll take some questions if people have any questions in regards to this first part before we start getting into the specific examples that illustrates sort of the markets and transitions and operational leverage.
Okay, so we do have one question that's come in so far, and Praveen is wanting to know, where do you think we are in the economic cycle?
Well, I guess it depends upon which business you're talking about. I mean, all businesses are basically going to be, some businesses are more economically sensitive than others. I mean, it's an interesting question because what's happened was the economy was chugging along, and then COVID happened and it cut short that particular sort of cycle, and we sort of went into a downturn because of COVID, and now we're sort of recovering back out of it. And so the question is, okay, sometimes you'll have external shocks that will drive the numbers back down. Will basically cut off the economic aspect of it. But I think part of it is going to be what's going to happen with Ukraine and the impact of sort of prices on that. That's not my area of expertise. I focus a lot on company specifics and what will happen in terms of the economic, where we are in the economic cycle. I think that, you know, I would say we're sort of in the mid innings, not necessarily in the late innings now, but because we've last year and last 2 years ago now with COVID was when we were in a recession, and usually recession, expansions last for a longer period of time.
Mm-hmm.
Now the additional thing that's happening here really is it could be China and China's response to all this, and from what I've seen, at least from the readings that I've done, so yeah, and various folks that have sort of discussed this, is that China's reaction to all this has been to continue to invest in their infrastructure and creating more and more products and services. And so what that would tell me is that there's there would continue to be growth from that perspective in terms of providing relatively inexpensive goods into the US. But then again, it's going to be offset by the amount of money that was sent out by the government to folks in the US, and that has ended now, and the demand aspect of that has come down. So it's a complicated thing, and I think depending upon which specific industries you're in, you'll sort of see that. In terms of the two companies we're looking at, Scripps, its advertising revenue would definitely be affected by that, but it has a lot of other sort of recurring revenue, like from retransmission fees that basically offset some of that. But I think clearly through COVID, the advertising for automobile dealers has definitely gone down, and with the shortage of cars, that has sort of extended that a little bit. But they've been able to find other avenues to actually buffet their cash flows from that perspective. So I mean, part of what you want to try and do, and something I like to find, is companies that cash flows are not necessarily tied to the economy. And we'll see in both the cases that we go through that there are some sort of contra-cyclical or less cyclical aspects of the businesses. And I think that's one thing you can take a look at. And if you can find a less cyclical business at a decent multiple, then I think that's an interesting opportunity now from that perspective. But yeah, I think
All right.
that's so.
Thanks for
All right,
that.
so we'll move on to the specific sort of companies we're going to be examining in this presentation. So the first one is EW Scripps. Now, this company traditionally has been, I mean, people may know them because of the Scripps spelling bee. That's one of the things that they continue to do. So historically, this has been a newspaper out of Cincinnati. The company focused on basically providing alternative sources for the common man in terms of news sources. And so through its history, it's had a lot of different businesses. It actually had a cable content business called Scripps Interactive that basically it spun off. Now, for its legacy newspapers, it did a really interesting sort of capital allocation decisions. It merged it with Journals Group, and then basically spun it off. It spun off its newspapers, merged it together with Journals Group, and that became a company. Historically, they actually had a cable business, which they sort of sell, and the podcast business. And right now they're in the consolidation of both local and the TV networks business. So this business, over time, what's really sort of impressed me is they have this grow, consolidate, spin off, or sell approach to capital allocation, which I think is really a neat way to do it. Interactive Corp is another one that does this, where they'll just take a business and grow it. And if they don't think they can add any value, then they basically sell it and move on to stuff that they can focus on. That's exactly what Scripps has done over time. And right now they're sort of in a transition where they've sold a podcasting business recently, and where they bought a networks business, Ion TV, with the help of Berkshire Hathaway, finance that deal. And so they're building TV networks, which then can be sold over cable, over the air, and then also through the CTV market. like I say, there's two areas of focus. The first one is local content creation and distribution, which is the traditional local TV business. They're the primary, the television businesses have been the primary generators of local news in regions, as newspapers have a lot of them have ceased to exist and stuff like that. So they've been the main generators of local content. And then so that's the local business, and then there's a nationwide one where for the nationwide one, this is developing their networks, and it creates a lot of distribution. So for example, they've got Ion, they've got Grit, some of these smaller networks that basically court TV, where basically they can develop they have a certain amount of content that they can develop and use, and then basically sell that these networks to advertisers. So what really becomes appealing to advertisers is they have a lot of reach, and right now they're working with some of the CTV providers like Roku at this point to actually provide CTV ads that can be more targeted. Now with the evolution of ATSC 3.0, as they're expanding into the markets, they should provide that in other platforms beyond just Roku. But I think it's a real, what these guys have done is they've really shown a nice sort of roadmap going from the distribution today to the distribution of tomorrow. And I think that's the key piece in my mind. As we talked about earlier, the market's expecting this company to decline, so they're expecting this bridge or roadmap to the future for someone else to take that and for these guys not to get it. And so basically trying to, and so what you try and look for is there evidence that that's not the case. And that's sort of the points that we're going through here, is to say, hey, this business is not a declining business. It's actually has a decent chance of growing at a reasonable rate. And therefore the 20% free cash flow yield that's put onto the business doesn't make a whole lot of sense. Maybe it's probably better to have, I don't know, 6 or 7% free cash flow. And if the cash flows are growing, that will lead to some interesting re-rating if that turns out to be the case. The other thing they have is they're the largest spectrum holders. And one of the things with ATSC 3.0 is you can actually do broadband broadcasting. So they've just done so basically you'll be able to get full TV in cars. And so they've just done a test run in Michigan to really show, okay, how does that really work? What's the handover from the antennas and stuff like that? And so they've been able to make it as seamless as possible. So it's a really interesting channel to basically provide broadband broadcast content in mobile devices, primarily cars. And it's saying that the 2020 Ion Networks was financed by Berkshire Hathaway, which to me sort of says, okay, Berkshire is very selective in terms of who they choose to invest with. They like to find guys that have good, strategy, and that basically will, can get a decent rate of return. I think these guys have a combination of both, and that's really sort of, in my opinion, really a validation of management here, in addition to the other factors of historically sort of what they've done and some of their track record. The other thing that's happening here is that they'll be able to get a good amount of cash flow. The way these businesses work is that during an election year, they get a lot of incremental cash flow. In other words, there's very little incremental cost. And so what they can do is they basically can get, because the politicians are willing to pay more money for this network, they get this bump every 2 years in terms of additional cash flow. And so that's another aspect of the business. And they should be able to rapidly pay their debt down pretty quick. I think that's one of the things that right now, after the Ion Networks acquisition, the leverage was somewhat high, maybe 5 times EBITDA, but now they're going to pay down to 4 and 3 times over the next few years as the cash flow just comes in from these various operations and as these things start to really sort of click together. So as we talked about, this company has sort of a quad approach to growth. So the first part of that is buying local TV stations and rolling them up. These guys are in a position that's probably better than some of the larger guys who have reached the cap. There's a cap in terms of the percentage audience share that you can have if you're a local TV broadcaster, and these guys are still below the cap, so they can continue to take advantage of that aspect. I mean, that's a long legacy stuff that's happened all the way back to Tom Murphy with Cap Cities ABC. So those are well-defined and known synergies that can happen in the markets. The same thing's going on with networks as they're buying networks, because the two networks they bought, they bought Ion and Cats, sort of combining those two provide sort of the growth from that perspective. There's going to be organic growth of the TV networks. It's going to be relatively modest, like maybe 3%. But then you're also going to be able to tap these other channels that may actually flatten or increase that a little bit more, especially if you can get tied into CTV ads, who currently probably have CPM rates of 3 to 4 times just the linear TV ads. And so what that really allows the advertisers to do is to more pinpoint target specific people of specific individuals in terms of being able to, or demographics of individuals, to do more target marketing with. The last one is sort of the other thing they'll do, like we mentioned before, pay down debt and buy back shares. So in terms of how it's structured right now, you have the local TV stations are sort of clustered to take advantage of economies of scale. Right now, that business is generating about a 20% EBIT margin with 8% growth in terms of the local TV historically, and what that really has done. So that's really as a result of, over time, the margins have gotten more, and as they roll them up, that's provided like an 8% growth there. Again, there's sort of a large runway because they only have a certain, the local TV share percentage they have is much lower than the cap. And then the other aspect of the business they have, which is 50% of the business, is sort of this networks business. They have very high margins. They're 41%, and they have 10% organic growth. And right now, that's something they're really focusing on. And they have at this point, the number of CTV ads, which have the high CPMs, they have a very small portion of those. And over time, they're expecting that to increase quite a bit and add to the value of the networks that they've sort of put together. So we're going to go over specifically some aspects of both the businesses that they're in. When we talk about the local TV, it's key source for local news, weather, and events. The way the model is built up is, in the US, you get these retransmission fees, which basically historically have converted lumpy advertising revenue into recurring revenue. So these retransmission fees are paid for by the cable companies and or OTT providers. Basically, those are guys that cluster channels together, and you pay a subscription and they get part of that. The other aspect of the business, which is interesting, is the elections. We had mentioned that before. Every 2 years, you've got state, local, every 4 years, the federal. So you have constant election stuff. This historically has been a very recurring revenue stream, and it's grown over time. And it's especially important in swing states. And actually, Scripps has a large footprint in some of the swing states, and so those become very important. The nice thing about political advertising is you don't want, at the end of the campaign, you don't want to have extra money left over. So guys, they have a huge, rationale to spend. And what they've really found is to get the message out, local TV and local media has been a prime way to do that. In terms of actually trying to reach people for fundraising, that's where Facebook and some of the other more targeted media, but with ATSC 3.0 and they may be able to get more, they may be able to target more specific people in that. But that's I think a nice chunk of revenue that's going to continue to grow over time. We talked a little bit about the scale and acquisitions and sort of what's happened. We talked about like Tom Murphy, sort of his model at Cap Cities ABC, do the same sort of thing. Nexstar has done that, and Gray has done that. They've had very good historical growth rates as a result of that, and that you do see the operational leverage. So actually the EBITDA and free cash flow will grow faster than the revenues due to the synergies that's happening there, because there's definitely quantifiable sales, marketing, and production cost synergies that happen in these types of acquisitions. The other aspect of these businesses that's good is they own the local spectrum. The nice thing about that is they can sell or lease to use for others. Now, in other countries around the world, they don't own the spectrum; they have to lease it from the government, and so that makes it a little bit of a difference in terms of U.S. versus some of the foreign companies that are sort of in this. And the other thing is that, like for example, with the local spectrum, they can use this the ATSC 3.0 for data casting, and they're just starting to take a look at what these opportunities are. And the recent sort of things that have happened is sports betting advertising. That's been a larger part. So, auto advertising, these guys have had a tough time doing it, because what's happened is, although the demand is recovering. There's no cars, so there's few cars. So in essence, the dealers are not spending a whole lot on advertising. But what's really replaced that has been sports betting. And the interesting thing about sports betting is the local TV guys have an advantage over the streaming and the other folks basically for in-game betting, because the latency of watching sports over time is less in broadcast TV than it is in the other sort of medium. So there's clearly an advantage there. And so we'll sort of see, apparently there's a lot of this going on in Europe. This is an opportunity, I think, what most people have sort of said is probably like a 3-year plus opportunity in terms of the actually in-game betting, but it can be a very large opportunity plus the other pieces that are here. And then there's the ATSC 3.0 opportunity we mentioned earlier. Primarily what this is going to be a new standard. It's going to give you a better picture and sound quality than you have now for your local TVs, and allow your TV to stream to mobile devices versus just going to a specific TV now. A lot of this is dependent upon getting this ATSC 3.0 chipset in receivers. And right now they're in the process of, more and more TVs are actually sort of adopting this, and they're developing chipsets for phones and other types of devices where folks will be able to do it. The key thing with this in terms of ATSC 3.0 is this protocol in combination with the internet connection, which most folks will already have, is they basically can provide CTV ads, which basically provide a lot more demographics. And right now those ads are probably selling for about 3 times what the linear ads is. And that's important for a guy like Scripps, where they actually have in their latest presentation, they talk about all the different platforms, CTV platforms that they're basically become a part of in all their networks. And so by the end of next year, all their networks should be on all these CTV platforms, and it should become these CTV ads should become a larger and larger piece with these higher CPMs versus in addition to the linear programming, the linear ads that they've got on the normal TV channels. Now, the other aspect of the business, which I think we said up front is about roughly like 50%, is the US networks business. The US networks business has been very profitable. Historically, it's been the distribution between the content creators, watchers, and advertisers. It began with the big 3 networks. Now there's been new networks that have added over time. And now it's become more segmented and fragmented as there's different technologies, streaming being one of them, is added to the mix at this point. So right now, the key thing for Scripps networks, and they've had and expect about a 10% revenue growth going forward in this business, is because of both their nationwide reach and the CTV ads, as we described earlier, in terms of getting higher pricing. So they really believe, and up to this point, they've done it, basically been able to get 10% revenue growth in this area. And given the operational leverage in the model, it should lead to higher than 10% EBITDA and cash flow growth from this particular business. And so you take this and you combine it with the linear TV piece, and we got a slide later that'll sort of go through some of that. But here's sort of the historically what they've done. So they've got decent growth over the past 5 and 10 years in terms of revenue, EBITDA, and free cash flow. And so as you see in most of the cases, the revenue, the free cash flow, and the EBITDA is higher than the revenue, basically reflecting sort of the operational leverage in the business. Management's been very skilled and used all the various types of ways of capital allocation to add value. So they've done spin-off, they've done sale, they've done acquisitions. So they use all the tools in the tool basket to sort of maximize shareholder value. Right now, their debt yields around 6.5%. So right now the common stock trades forward around 5 times. So that's about a 20% free cash flow yield. If you combine the two, it's roughly 25%. A good size spread between the two. Usually, the ERP, which this is equivalent to, let's say, like the ERP, which usually is like 6%. So this is almost double that. And it's the EV to EBITDA is roughly 8.6 at this point. But the key thing is going forward, it's going to be growing, and the debt portion of this should be paid off. So that's actually going to be, the forward numbers are, well, at current prices should be significantly less. So what are some of the challenges with this? The first one is the evolving and competitive CTV market. Clearly, Roku has a huge advantage being the first player in that market. Right now, I think the revenue splits are 70% to a network provider like Scripps and 30% to Roku. I mean, that could change if they become really, really dominant. But right now, I think there's more players in the market. So I think it's, that's that particular challenge. We'll sort of see what's going to happen. But I think given right now the low base that Scripps that's coming from, that any increase would be accretive to sort of what they're doing. And then they also what's happened over time is there's been a good amount of consolidation in the market. So the targets that Scripps has in terms of newer TV companies, local TV companies they can buy, has declined due to the other consolidation that's happened. But I still think that those opportunities are out there, especially since a good number of TV stations are owned by private owners that at some point, maybe through succession or whatnot, will sell the businesses. So a little bit on the management incentives. Right now, management and directors own about 3.3% of the shares. Equity ownership, the CEO has to have 3 times his salary, the other management 2 times their salary. The way the incentive is sort of set up, there are 2 metrics that they focus on is operational cash flow and revenue growth. And they do have a good amount of incentive sort of compensation. About 20% of their salary is base, between 70 and 80% is performance based. And again, the same thing for the equity incentives. Right now, if you take a look at the equity granted per year, it's a very modest 1.5%. So I mean, I think it's, as a shareholder of this company, you're basically going to be retaining like 98.5% of the economics of the business, which I think is a good on a yearly basis. I mean, if you do this over 5 years, you're gonna you'll be able to, as a shareholder, be able to reap a good amount of the economics of this, as opposed to if a company's giving away a larger percentage, then the employees are getting a good percentage from that perspective. So one way to sort of look at this is where we sort of pull it all together, sort of get an idea of sort of what's going on with the company. Now, in terms of what I've sort of set up here is that the way you look at these TV businesses is that every 2 years is where you're going to get the growth. And so there's a 2-year cycle. So that's why we've got 16% growth in 22, and it actually goes down in 23. And what that's really reflective of is the election, the impact of the election. You'll see this in these types of businesses. So overall, the business, in terms of revenue growth, now the numbers through 2025 are based upon analyst estimates, and then after that, I'm sort of tailing it down a little bit. But you can actually see there's going to be a decent amount of growth in this business going forward. And what are the real drivers are there is the TV network growth of 10%, local M&A growth. This consolidation we talk about is another 4 to 5%. The local growth for TV is about 3%. Excuse me here. And then ATSC 3.0, which is an additional, add another 5%. And so you'll see, if you add all these together, they could potentially be higher. But again, this is just sort of using a reasonable set of assumptions and not being too aggressive in terms of the revenue growth here. Now, the free cash flow margins, as you'll see in here, they alternate year over year, again, basically due to the election cycle. Now, the election cycle creates a lot of incremental revenue, and the incremental margins are very, very large because a lot of the costs are fixed. And so that's what you sort of see here. You'll see that the local TV network economies of scale, you get some operational leverage on that. We're assuming 60 basis points every 2-year cycle as they consolidate more of the business on both the network side and the local TV side. And then the other assumption we're making here is that once that level reaches 3 times EBITDA, we have some share repurchases associated with the free cash flow. So if we look at the overall numbers here, we're getting free cash per share growth of probably like in the mid-teens. Right now, if we project it out 5 years, you're talking about like a 2.2 times free cash flow 5 years forward, which is very inexpensive. And so you've got a really interesting potential upside here. And the fact that again, I think the way the business is being valued now at 4 to 5 times free cash flow, it's assuming the business is going to decline. This is what it would look like if it doesn't decline based upon a reasonable set of assumptions. And you can see there's a large difference there. And that would basically generate a very good return for investors going forward. These are just other local TV firms and sort of valuations associated with those firms, and various numbers. You can see across the board, the price to free cash flow number is relatively low. So everybody's saying this whole business is basically going to be declining. So there may be other opportunities in here, but at this point, I think Scripps is a very interesting combination of them, because Scripps basically has both the networks business and the local TV. Both Gray and Nexstar are focused primarily on the local TV market. Scripps has a combination of both. Sinclair has some local TV, but they also are big into, they bought a bunch of regional sports networks, stuff like that. So that one's more of that aspect of the business. And then we've got some benchmarking. You can see all the companies have very good EBITDA margins and free cash flow, return on equity, and some very good growth numbers. Again, the historical growth numbers are really driven by Gray and Nexstar in particular. And even in these other companies are really driven by historical consolidation. And clearly the prices they're paying today isn't expecting that to continue. There may be some, but our numbers that we've put together here are not really assuming a whole lot of that's going to happen. And so in terms of the conclusion for this, right now, we've got it at 4.6 times sort of current earnings, 2.2 times 2026 earnings. Again, if we just take a look at using sort of the Graham formula there, with 3% organic growth, we get a 15 multiple, 6% with M&A, it's about 21%. Then if we add M&A and ATSC 3.0, which would give us a 10% growth, we're like at 28.5. So in essence, if you add these different pieces in there, you'll see this company at the current valuation is relatively inexpensive. And so, what you'll get a combination of, as you see, is that the cash flows grow as we show as we expect. Then you'll get a combination of both a growth and then a higher multiple, and that really will create a very interesting situation for investors. And so what you're really doing here is you're buying growth for a more than reasonable price. I think in terms of the combination of what they have, this is the best combination of a national network and a local TV network that you can buy out there now. And then you will get a good amount of upside from ATSC 3.0, since they are the largest holder of US spectrum that basically provides those types of services. So at this point, I'm going to take a break and see if anyone has any specific questions on Scripps before we move on to our next example in regards to consolidation and market fragmentation.
Okay, we don't have anything specific to Scripps, but it is kind of related in regards to that it deals with media and entertainment industry.
Okay.
And they're wanting to know within this framework of consolidation and growth, what's your opinion on Discovery and Warner Media? I'm sorry, recent merger. Is there any growth there?
Yeah, I mean, I think the challenge. I mean, both the companies have really good models. In terms of what they're put together, the challenging aspect of and they do have networks, and the challenging aspect of some of those is just. And they do have a really good way of creating content that doesn't cost a lot. The big challenge, I think, in the content aspect of the business is actually creating content for a reasonable price. And I think they've done a decent approach to that. The one difference between like Scripps and some of those types of businesses is these guys have the access to the local markets, which provide, in my mind, a little bit more cash flow stability. And then in addition, you do have this additional optionality with it. So, those additional cash flows. So I think it's a very interesting combination. I think it makes a lot of sense in regards to sort of combining the various content operations the way that they're doing. But in terms of what the in terms of looking at from a consolidation perspective, it's I think that looking at both Scripps and the other local TV providers, you can see direct actual sort of synergies going on there, and the fact that you're building stuff using common customers and common infrastructure. I guess from that particular media, from that particular merger, you will have some common sort of advertising customers from that perspective. But it's I think it's interesting, but I think these Scripts specifically provides also exposure to the local TV market. I think the other thing too is the pricing for that what I would say is honestly, where I think the opportunity is just in the fact that you're going from a declining business that's being priced as a declining business when it's not. Now, the Warner Media / Discovery, I think has a little bit higher multipleness. So I think there is some growth in what the multiple is for that. And so it's not quite so the market does have some growth expectations there. I just think the growth expectations for Scripps is a lot less. And basically to be able to meet it isn't going to take a whole lot. And therefore it's an easier target to go over. I mean, the way you can think about these businesses is if Scripps just survives and stays flat, it should sell at 8 times. I mean, now it's selling at 5. So you get a premium for it just surviving. But if it grows, then you get some really nice operational leverage. But I think there is some growth baked into the sort of the Warner Discovery at the current multiples in terms of what's there. And so what I've sort of tried to focus on are the places where there's negative growth, and any positive surprise will really create a nice pop. I'm sure it'll provide pops across all of them, but the ones that actually have implied negative growths, if they do end up with positive growth, because you're always comparing, okay, what does the market say is in the price versus what reality is? And I guess what I really see in Scripps versus, let's say, say Warner Discovery, is that gap between the two is larger. And that's where I try to focus my research, and the stuff I'm looking at is trying to find, okay, where is that biggest gap between what the pricing says the stock is and what's a reasonable set of assumptions in terms of the scenario, in terms of it laying out there. So I mean, a similar kind of methodology can be go through to do that. But what I try to focus on is where I think that biggest gap is.
Thank you.
So, okay, so we'll move on to the next sort of case study that we've got here, and that's a company called Consolidated Communications. Now, Consolidated Communications is a legacy rural telco business that basically it's got a number of different locations around the country. It made a very large acquisition of Fairpoint, which was the old Baby Bell lines in New England. And so they have a very large amount of legacy copper. And so as you can see here, these are just some of this here. I'm going to the specific pieces here. But what they've got is they've got 2.7 million homes passed in their areas. Right now, they've got about 300,000 that are passed with fiber. They've got and they have this what they call Giga Plan, which is sort of in New England, where they're going to be passing an additional 1.6. So when this plan is done, they'll have 1.9 million of the 2.7 million totally hooked up to fiber. The one thing I like when I look for these types of businesses, I like to find companies that have no or one competitor in the market, because what can kill a lot of the economics of these businesses is competitors. So in 92% of the markets that Consolidated competes in, they have one or no competitors. Only 8% have 2%, 2 or more competitors. And that's where, as you look at the economics of these things, the market, as your market share shrinks, if you get into 3, if you're down in the 20s, it really can be tough, 20s and the low 30s, to make a good amount of money. But if you can get into the 40s and 50% penetration rates, that's where you can make the profits are just incredible, because you have a fixed cost and every incremental user is large. And there's actually a slide in this presentation where we'll show, okay, here's if you look at its penetration rate versus value per subscriber, and you see it's a linear line. In other words, so as the penetration rate goes higher, the value per subscriber goes higher. And so what we try to focus on are those ones where basically, and one reason why the only way you can really get high market share is if you don't have that many competitors. And so that's what the focus on of this particular investment versus, let's say, some other companies that may have more competitors in their markets. So right now, for the markets that they've rolled out and consolidated, it's got 30 to 40% penetration rates. I think longer term, they probably can get up to the 40s, mid 40s if you only have 0 or 1 competitor in your market. I think that's clearly an achievable target. They have high NPS scores experience. They hired a former executive from Google Fiber to run it, and Google Fiber had high NPS. And so I think these guys have put together a very interesting package to sell to. At this point, most of their footprint is in New England, but they do have advantages over other people that are overbuilders in those particular markets, and they are competing against. Primarily, the cable companies are competing against is Charter and Comcast. Charter is probably the most fierce competitor of the various cable guys, but these guys have done pretty well against Charter in the markets where they've rolled out fiber at this point. So if we just take a look at the business, some of the key assumptions here is they have a core business which consists of business lines plus their existing fiber network that already exists out there. That core business will stabilize by 2031 as more of the copper is replaced by fiber. And then they are going to have a big drop off in 2022, because they're going to lose some subsidies. And because of the decline in various video and voice members. So what these guys have decided to do is they've decided to actually fund the network independently and not take the subsidies for some of their markets. But I think to go back to bridge the gap from the 1.9 million, which is at the end of their plan, to 2.7 million, I think at that point that they're probably going to need subsidies to do those customers. But at this point, they're not focusing on that. And at some point, if they do get that'll be additive to any sort of a plan and what we're really describing here. So right now, the fiber overlay will result in revenue increases by 23-24 in terms of when it will, because right now you've got a declining revenue stream and you've got an increasing revenue stream. That's going to cross over. You'll actually get 5 to 6% revenue growth. You get revenue growth to 5 to 6% in 23-24 and EPS growth of 20%. Because what will happen is you have a fixed network and you're just getting new customers on that existing network. And again, the focus here is just focusing on plate markets where there's not a whole lot of competition. And that's how you can get the 40% plus penetration, is if you're in the 0 and 1 markets. If you're in the 2 to 3 to 4 markets, then it becomes much harder to get those higher numbers. So profitability, again, the incremental profitability is going to be high. The network that they bought from the New England network that they bought basically included a lot of fiber way down the line, so they're relatively close to the homes. The other aspect of this business is they've got aerial connections, so it's connected on telephone poles to people's houses, so they don't have to spend money digging up the ground. And then they're the only people that basically own these assets, so they basically have a cost advantage over someone else having to dig up the ground to put competing fiber in the ground there. They think that their long-term EBITDA margins can approach 50% because of the operational leverage that happens here, and the fact that once they have it set up, the cost of adding an incremental customer isn't that high, but it's just incremental revenue. A lot of it can fall to the bottom line. The economies of scale, because of their focused footprint in the various geographies they have. We'll see later that we assume you can probably get like a mid-teens IRR, assuming a $60 high-speed internet pricing, which I think is pretty modest. Actually maybe higher in some places, but I think that's the way it is today. And the other thing about this is the cost of debt. will create a favorable position. If you have 17% IRR and you can borrow at 6, there's sort of a little bit of a spread you can make there between the two. Now, the nice thing about this business is that Consolidated has a fully funded business plan. So they do have Searchlight, which is a private equity firm, has provided funding to basically allow this to be fully funded, which I think is very important. And the fact that, and they have in their early rollouts of this met their benchmarks for penetration and rates of return, which I think is important as this rollout continues. And they have also, like saying, being able to prove to have lower cost to connect, and which we'll see, a cost to pass and cost to connect than some of the competitors, just due to their advantageous infrastructure position that they've got versus other people. But in any case, so we'll start we'll go back and we'll take a look at the broadband. So basically, broadband industry, it's cable, telecom, wireless, and overbuilders. The local markets have network effects, as you'd sort of expect. More competitive in urban markets than in suburban markets and rural markets. Sometimes there's only one competitor just because of the cost associated with it. And some of these local markets can be further consolidated. You see some of the cable companies rolling up these various businesses over time. One of our main focuses in terms of, we think gig speed internet is going to be a core infrastructure service going forward. Everyone's going to need it. The government's has provided $40 billion to the states to basically encourage this to happen. Now, Consolidated's not going to be a direct beneficiary of the first batch of that money, but I'm imagining that the second batch, when they get past 5 years, when they try to reach out to those additional 800,000 customers that aren't going to be past 5 gig, they will be a beneficiary of that. Right now, there's many privately held overbuilders that have been started and are in operations across the country. We actually have one here. I'm in Rochester, New York, called Greenlight. It's done relatively well, competing against the Time Warner Cable Company and against Frontier, which is the legacy telephone provider here. So we've got a three player market here. But Greenlight's done a great job. And just to get an idea of sort of what they've done, is they've actually been able to, they basically won't lay fiber till they have a bunch of people signed up, and they've been able to get a number of people signed up in a number of the communities here. And part of that's just a reflection of historically the poor customer relations the cable companies have done. I mean, I think they're trying to improve it now, but the cost benefit is just so much better just with the with this independent provider and some some of the other things you can sort of pull together. So their value, it's not only customer service, they have a better value proposition also, which I think is key in this business. When you want to have a service that people really want at a price that's competitive. I think that's a winning combination when it comes to broadband, especially if you're in a market with only one or two other guys. This can be a very interesting opportunity. So, and then generally, I think there's going to be 30 to 40% studies of, say, your broadband usage over the next few years. And so what may happen is some of the other technologies that can't deal with, expanding in terms of capacity here, may run into some issues, especially if this broadband usage continues to go up and if there's some kind of killer app that's going to require a lot of this. But even if that doesn't happen, these guys are going to be competitive in the markets. If it does happen, then they'll probably be better than, let's say that some of the cable companies in regards to the bandwidth offering that they can provide. So the key thing here is that I think is interesting about Consolidated is if you take a look at their management incentives, this changed over the past year since Searchlight has come in. Is they actually have the metrics as part of the management incentives, whereas before the incentives were primarily driven by just revenue and cash flow growth. Now you've got specific metrics of laying out this fiber optic sort of network that they're putting together. So I think that's definitely improvement, and it will focus management's attention on those particular aspects of the business. Right now, the implied security returns, the debt interest rate on this is roughly 8.4% yield. Now, right now, it's common stock trades at 8.6 adjusted, but again, that is a situation where you've got a legacy declining and the full ramp up of the existing business is not really reflected. That's not, and you'll see when we talk about the 5 years out, it'll be reflected in that. But currently, it's not reflected in the multiple. So you've got a spread of around 4%. But again, that's what I would say is in a lower than expected number from a current perspective. So in essence, it's a good portion of the value of this business is based upon what's going to happen over the next 5 years versus what's happening today. Versus like when you take a look at Scripps, there's a lot of value today in what they've got. In Consolidated, there is some value today, but a lot of it's based upon what they're going to be doing in the next 5 years, more so than let's say Scripps is. So again, sort of the challenges of growth here is final penetration rate and the speed of penetration. Those will affect sort of the cash flow profiles that are going on here, and the pricing competition from incumbents. So in each of their one competitor markets are primarily competing against Charter and Comcast. And so those, I know in my local market here, Charter's been very aggressive in terms of trying to reduce their prices. I mean, who knows how that's going to play out over time, but I think in a 3 or 4 player market, in a 3-player market, it becomes much more of an issue than, let's say, in a 0 or 1 competitor market. When you've got a larger number of competitors, price competition, I think, can become more of an issue. So again, let's take a look at management ownership, 1.3%, 5 and 3 times the salary of the CEO, very similar to what we've seen over at Scripps. Sort of the same thing in terms of base and incentive compensation. But again, the key thing on this thing is they have specific metrics that they're looking at for the network rollout, which I think is important, which is basically saying that's what management is sort of incentivized on. So that's what they're going to be spending their focus on, which makes sense because that's the future of this business. And so they do have, the various operational metrics, and they do have an overlay of 3-year relative shareholder return versus a comp group. And again, these guys have modest equity grants similar to Scripps in regards to the amount that they're giving to management and employees to run this business. Okay, and so this is a forward-looking forecast. Now, it may look simple, but there's a lot of stuff behind this. So what I've done here is I basically said, okay, here's sort of the revenue numbers going forward. And this has a combination of building up the core business plus the new business on top of it. That's what's sort of behind the curtain here. You can't see, but those are the resulting revenues or the adjusted net income numbers, which basically would remove any sort of amortization associated with acquisition, which there isn't a whole lot, but the adjusted net income numbers there. And then the EPS. And so you'll see right now it's selling for 8.6 times, call it like 2021 number. Now next year it's going to go down again, sort of the dip in this thing. But if you look 5 years forward, it's 4.5 times 5 years forward, which I think, as we had mentioned before, that's where the growth dynamic of the new network, the new business, basically overcoming the old business at that point. And so some of the key assumptions that we have there is 5-year penetrations from 10% to 40%, assuming average broadband cost of $60 plus 2% increasing per year, which I think is relatively modest. And then some of the other aspects of the business is the fiber rollout will use the existing fiber infrastructure, which gets pretty close to the home. Connect costs are only going to be $350 per pass and $400 for user equipment. Why it's so low and compared to everyone else is they have the aerial lines to connect to the user versus the other guys having to dig up ground to get there. And then I'm saying, as the operational margins, as management has stated, will lead to what they think is, which I think is reasonable, 50% EBITDA margins, which is sort of what we see in some of the cable companies that are fully built out and can just add people on the end of their infrastructure. And then the debt pay down will also increase EPS as we're moving forward here. This, I think, is a real interesting. So this is what I was referring to earlier in the presentation, where we've got EV per passing and penetration. And you can see we're talking 40 to 50% penetration. So you're talking about $4,000 per pass, which is roughly about the valuation that we came up with. But this is just another, I really like this framework in terms of the way it's sort of set up. You can see right now where Consolidated is, which is down at around 20%. But as the as they incorporate fiber, more and more fiber into their network, they should be able to get closer to the 40 and 50%. And that's where the $4,000 per pass type of evaluation metric makes sense. These are just sort of comparable companies, and where Consolidated sort of falls into those. You can see right now they as you go forward, the price to earnings multiples are very, very modest. And so what the real play here is that you're going to have increasing cash flows, increasing earnings going forward 5 years. And if you buy it today, we should be able to get both multiple appreciation and earnings appreciation to add to a very interesting sort of total return expectation here. So again, as we talk about, we've got 8.6% PE right now. It's 11.6% earnings yield. We project out to 2026, we get 4.5%. Again, using sort of the grand formula to give you some benchmarks here. Over 22 or 48, depending upon what kind of long-term growth you're sort of seeing there. Clearly way under each one of these. And so, if the fair value, say it grows a 7% long-term growth, we're at 22. I mean, that gives you sort of almost I guess it would be a 5+ multiple to get up to that number, plus growing revenue. So you get sort of that combination of the Davis double in these types of businesses. So what you're really doing is you're buying a leveraged U.S. play on fiber rollouts. This is probably from what I've seen, probably one of the best pure play ways to play it. I mean, there are other people that are doing this. Most of the pure play fiber stuff is done privately through private equity. So I think this is one of the best ways to play pure play fiber. Frontier is also doing this, but the percentage of fiber that they've got versus Consolidated is less. And that's why I sort of favor this one versus Frontier, which is doing the same thing. Frontier is still going to have a good amount of legacy numbers going forward, and Consolidated should have more direct fiber exposure. If you look at the other pure fiber companies, they're selling around 20 times EBITDA. And again, this business, even going forward, the terminal multiples we sort of assumed here are 9 to 11 times, so half of what a pure sort of fiber would be. As sort of another rough sort of comp here, right now the company's selling it's like a little over 5 times EBITDA in regards to in terms of the current valuation. If you look at another company that was recently purchased in regards to that, I would say is a sort of an in-process type of a valuation. It would be Cincinnati Bell, where they had 50% of their homes passed with fiber and was purchased for roughly 7 times EBITDA. And there was actually a bidding war between Brookfield and McCurry, and I think McCurry actually won that bidding war. But if we take a look at what the current EV to EBITDA of the company is, it's like 5 to 6 times, versus the 7 times that was paid for Cincinnati Bell. So those are 2 examples of sort of the consolidation and the market fragmentation aspects of the business and the markets in transition. I think the main thing I wanted to sort of provide to folks is, if you take some interesting opportunities can be found in these markets in transition, and in sort of digging into a little bit more, you can find some interesting legacy players that are adopting some of the innovations and can get some real interesting, and you can find some real interesting potential investments amongst those types of companies. So at this point, if anyone has any questions, I'm willing to take them.
All right. So this is in regard to Consolidated. He said the company has very high debt. What are the chances of it going bankrupt?
I think the possibility of it going bankrupt is relatively low. I think given the private equity aspect of this business, I think there's probably a higher probability of the private equity firm possibly trying to bid and take it under. I mean, they did have in their earnings, in their current earnings call, they did have a after the earnings call, the stock price did go down. And then after the stock price was down, Searchlight filed a 13D, which basically said they may look at buying part of, more of, or the whole company, looking at various options. So I think that's, in my mind, that's a higher probability than the company going bankrupt. I think they given the sort of cash flows that they have, and the models that are out there, I think that's the what's happened right now. So you do have a it is leveraged, right? But I think there's more than enough cash flow to sort of cover the amount of debt, the kind of debt that they've got. Usually one metric to look at this that historically has worked relatively well is John Malone has said that he's willing to, lever up cable kind of assets at like 5 times EBITDA. We're selling at a slight premium to that. So I think we're at the point where you don't want to add a whole lot more leverage here, but I think we're below the point of danger. I mean, early on in my investing career, I invested in cable companies that were too leveraged. And one of the things I try to look at right now is to make sure that the company is not too leveraged. And I think, absent us going into a cataclysmic long-term recession, where not only this company, but a lot of other companies would go bankrupt, but just assuming a regular, normal economic type of a thing, I think that I'm not concerned about. But there's the other things that I would probably be more concerned about would be, private equity. Their partner. They're basically trying to buy the business for under fair value. But I mean, I don't know if it's going to happen. I've got no insight into that. All I know is they filed a 13D at this point. So I've got no idea of what's going to happen there. But
All right, thank you. Another question in regard to Consolidated is, how does it compare with Altice USA?
So Altice USA is a cable company. The one thing that Consolidated does have is I think they've got growth from their fiber optic layout. I know Altice is doing the same thing there, so they've got the legacy cable stuff there. Altice, again, and this seems to be a common thing that happens with these companies, is one of the bigger risks I think at Altice now is the take under issue. Now, although Searchlight in their current incarnation and all their indications have said that that's not what their intentions are, Altice which basically it's controlled by a French Altice, and last year they took under the French shareholders in regards to the cable network over there. So, there's I think the difference is that Altice has an existing cable infrastructure. They're replacing it with fiber. I think it's a decent business. It's under distress. It's just that I think my biggest concern about Altice would be the management team there, given sort of their record of what they did in France over the past few years, may be repeated here, and therefore, But yeah, no, it's and the question on that one is the difference is is that it's a legacy business now. If they can sort of turn it around, and the issue is sort of just trying to keep the subscribers. Now, historically, the Altice properties have not had the best customer relations. I think they're probably trying to change that, but I mean, it's a typical cable company versus new fiberco coming in, and if a Consolidated can really provide a good experience, I think that would be definitely a plus to them. I think they're in a little bit of a different situation, since their footprints don't overlap as much. I think a good portion of the Altice competing with Verizon in terms of its FiOS type of a network. So you've got competition there. But I think I think the reasons why I like Consolidated over, let's say, like an Altice is just basically, even though, like I'm saying, I think one of the higher risks of them is sort of a common potential take under. I think it's a much higher probability in Altice because they've done it last year, and Consolidated hasn't. The management team of Consolidated seems to be a good management team versus, I think the management team in Altice in the past has taken advantage of investors by taking them under, which is not in my mind, something that it's a risk that you take, and that's part of the reasons why it's priced the way it is. I mean, and they also haven't met the specific performance, the market's expectations. It's levered to similar to, I think the leverage is probably a little bit higher than Consolidated's, but it's it's an interesting question, but I think I think the current prices I prefer Consolidated because I think the upside in Consolidated is probably a lot higher than the upside, let's say, in Altice, and then the probability of somebody taking the thing under is lower than it would be in Altice's situation. So I think those combination of factors what would maybe lean towards Consolidated over Altice.
All right, thank you. I think we have a couple more questions here.
Okay.
The first, what do you think the impact of 5G rollouts and then future 6G, etc. rollouts will be on fiber companies?
I think they may have some, but the fiber companies, I think that's the best way, and once you have the fiber in ground, the cheapest way to broadcast it. I think what's going to happen is there's probably more high value added applications where people will be willing to pay for mobility data more than they will for them trying to compete against broadband. And you're always going to have the issue, okay, if let's say you're buying your consumer, okay, in my mind, broadband connectivity is like the base. That's like the core piece of what you've got, and then you can add on the mobile on top. The issue with making the mobile your core is just the weather issues, these other sort of variability issues that you really can't get over with just, you can't change the weather. You can't change. So I think what I really think is going to happen is really both of them are going to do well. They're just going to do well where their strengths are. So broadband strength is it's a core network. You get lots of bandwidth, easily updatable from a cost perspective. Really a cost-effective way to get core broadband to consumers. Mobile, I think, is good, and just the ability, and its strength is in the ability of where it can actually go. You can be in a car and still have mobile. There's tons of applications in transportation and a lot of other sort of things where you're dealing with mobility applications. Broadband isn't going to work there. What you really need is you do need the mobile. I think that's where, in my mind, focusing on where the strengths of each of them is where they're most like where the higher value add is going to be, for each one of the particular sort of technologies that are out there. So I mean, I think there's going to be there will be competition, but I think the key piece that most people are going to buy is they're going to buy a core broadband, and then for their mobility needs, they'll actually use a wireless. I mean, because even if you look at like now how most people use their mobile phones, they're using their mobile phone next to a Wi-Fi hotspot. They're using the broadband connectivity there. They're not using it from the wireless provider. And so that's how the cable companies can provide these cheaper plans than just going directly to the mobile providers, is they know that you spend, as a consumer, you spend most of your time in your Wi-Fi hotspot, which is connected to their broadband network. And so it's one of these kind of things that, okay, and then the times you're not there, then you can switch over to their network. But in my mind, that's the most cost effective way to do it, and that's just the way it's sort of implemented today. So I think there's really a place for both. It's not an either or. um, and I think trying to compete in a place that's not your strength may not be the best use of your resources. Your resources may be better spent on where you have a competitive advantage versus not. And that's my thoughts in regards to sort of the broadband versus wireless. I think they both have their strengths and weaknesses, and if they focus on their strengths, I think they'll do well. If they try to go into an area where they may not be as strong, then you know it may not turn out as well.
All right, thanks for that. I think this will be our last question.
Okay.
Let's see. In your opinion, over the next 3 to 5 years, who do you think the top like 3 consolidators are over that time period?
In what particular business? Did it say what business? I mean, there's
well, I think they mean like in they were looking. I think they were referring to your chart in the first section of your presentation, and it had like Constellation on there and a bunch of other like Constellation software.
Oh, okay.
Yes, I think they're referring to that part.
Okay. I mean, I think some of the bigger guys that they're really interesting guys to watch to see what they do. Constellation's clearly amongst that one, because they by far do more acquisitions than any other company, and they've built a culture to actually do that. I think they're there, and then they've got a spin-off called Topicus. Those guys I think are probably way above other people. I mean, you've got guys like Danaher that's done some of that too, but it seems like a lot of these guys have sort of the more the platforms, but it's across different industries that the people are doing the same sort of thing. But I think the ones from what I've read and seen, I think Constellation is probably, if you want to look at one or focus on one, just focus on Constellation, because they seem to have they have a well thought out process of basically taking industries. So they're basically focusing on vertical market software, who once it's mature, it grows maybe 2-3% a year, but turning that business model into something that can grow tremendously, and just because of the way that they run it and the abilities to increase margins and just do some really neat things with businesses in end markets that are not growing that fast. And so I think you want to study one, that's the one to probably study is Constellation.
All right. Thanks so much. Well, Keith,
all right,
that's all the time we're going to have for today. So it's been an absolute pleasure to have you on. Thanks so much for sharing your thoughts with us and for taking time to answer our questions. If anybody missed anything, like I said, there's a full recap of this presentation as well as Keith's past appearance for us on Value Investing Live, available here on YouTube as well as on GuruFocus. That's all the time we have for today, so we wish you the best and see you all next time.
All right, thanks.